All right, let's go ahead and get started. Today is Monday, April 1st, 2 p.m. section. Happy April Fools. This class is being recorded. Here is the sign-in sheet. Make sure you sign the sign-in sheet for today. All right, so primarily what we're going to do today is talk about the Nvidia model and do 3 more files, the bull, the bear, and the as is, or the target off of the as is. We'll talk about how we then reuse the model, and we'll use Nike as a working example, which will basically be, we'll spend most of our Wednesday's class on. We'll talk about how we today reuse the data to do that. And then you'll be doing, the next homework assignment will be an individual assignment valuing a company. And somebody pointed out earlier today that technically the group project is next Monday, but that's going to be pushed back because we just need more time to do some practice on these valuations, right? But before we do, I also want to do a quick check-in on the Bloomberg Trading Challenge, which you should have already started working on. And let's see, you're section 301. So it should be listed as 301 2H. There you go. All right, so the good news is everybody's below 300,000 of available cash. You need to stay that way. You will need 10 longs over the second half of the semester. A couple teams have already hit that threshold. And wow. There's one team that has jumped out to a very early big lead. So I don't know what the K Wang team has done, but you don't have to say, but you're yes.
Was that the same team that got first last time?
I don't know. Were they? No.
We're in last now.
You were last time, and now you're in first.
No. We now are in last.
Oh, the team that was in first is in last. Okay. Well, I'm just saying, they obviously hit something pretty big. I don't know what it is to tell you, but that's where we are today with another 4 weeks to go. But yeah, it's impressive for about a week's worth of trading. So, but nonetheless, here's where we stand as of today. We'll do some check-ins from time to time. But you got to do the 2H. The 1H, the first one doesn't count anymore. It's there, but it's not being tracked. All right, questions about the trading challenge? All right, so let's go back to the as is. So the file that we did Wednesday, last class, which has a share price of $899.44, again, we've called the as is. And the idea is we've come up with a reasonable cash flow valuation of the share price at that time, okay? What we're gonna do next is create files number 2 and 3 called the bull and the bear, okay? And the general idea is we're going to eventually get to what's called a target share price. All right, for Nvidia, you can see that by going to ANR in Bloomberg. And these are the sell-siders covering the company. And over here where it says target price, this is where they think the share price is going to be in the next 12 months. That's what they call a target share price. Okay. And by the way, you can see as of April 1st, which was this morning, Bernstein analyst Stacy Rasgon put out a target price for Nvidia of 1,000. Here's somebody from a firm I've never heard of, which has a target share price of 12.30. Morgan Stanley thinks the target share price is 7.95. There's different targets on Wall Street. That's our fourth file that we're eventually trying to get to, which basically reflects our opinion of where we think it's going to end up. But before we get there, we're going to do a range, essentially a bull and a bear, meaning how high can Nvidia go reasonably in the next 12 months and why, and how low can Nvidia go in the next 12 months and why. That's called our bear, okay? And somewhere in that range will be our target. Yes?
If the target price that the Morgan Stanley analyst had put that is less than what the price is now, why would his recommendation still be attractive?
Good question. He hasn't updated it yet. He should change that to a sell. Okay. But, because those are two different fields that they have to update in Bloomberg, right? But that's a little bit of an inconsistency, right? But back to this, what we should be doing here before we get to our opinion is we need to do the bull and the bear, okay? And the two things about the bull and the bear I want you to understand is, number one, storytelling is actually a big part of finance, much more so than just numbers. And you need to tell the story of why the bull, right? So this is not just a math exercise where you just throw in a few numbers and say, here it is. You got to explain the why, okay? And when I talk about 500-word minimum papers, that's what the paper is going to be. I'm changing these assumptions for these reasons that lead to these prices, okay? That's kind of the process that's going to be very important. The other thing about the bull and the bear is it doesn't have to be symmetrical. I don't have to have the same upside and downside. I could have more upside than downside. I could have more downside than upside. But the point is I need to be reasonable about where I think the range is, and it doesn't necessarily have to be a symmetrical range, okay? But it has to be based on real world information. Ideally, this is why we do EICs. We should have done an EIC first on Nvidia before we do the bull and the bear. Now, for practicality this semester, just too much work. I'm not going to ask you to do an EIC for every assignment, but you should still do the sum of the elements of the EIC to help you do your bull and your bear. And I'll at least say start with a BICO. Okay, so for example, if I go to the BICO for Nvidia, what are some of the issues that are going to trigger upside downside? Just kind of summary of what's going on. So what are the analysts worried about? Number one, Nvidia just came out with a new chipset called Blackwell, which their current chipset, can't talk today, is by far the best in the market. And they actually came out with the next generation, which makes it even faster and even more of a competitive advantage. So that's gonna be a question. Like, how long does Nvidia maintain their competitive advantage? Are they like Intel back around 2000, where pretty much the only chips you could buy were Intel chips for Windows machines? And they just had dominance for 15 or 20 years and made huge margins because nobody could recreate the Intel model? Or is it going to actually happen much faster? Because a lot of people are trying to catch up with Nvidia. I was telling the last class, I need to look it up, but Amazon has spent a bunch of money. I think they own 30% of a company whose name I can't remember that's doing a chat GPT alternative. In fact, there are people that were working at OpenAI that left OpenAI, and Amazon was one of the companies that funded them. They just wrote another $1.6 billion check last week to create their own generative AI models for Amazon Web Services, rather than paying essentially Microsoft, which owns OpenAI. And the other thing that this company's trying to do is they're trying to create chips that do AI processing without having to use Nvidia. So they're trying to actively create an alternative. So they have proprietary chips that are much cheaper, that instead of buying all these very expensive chips, they have an alternative. Well, when we start thinking about the bull and the bear, that's going to start playing out into the bull and the bear, because there's a lot of companies, and Amazon's not the only one. The data companies want alternatives to Nvidia. They want competition. And if more competition shows up faster, well, Nvidia's not going to grow as much, not get as much of the pie, and they're not going to have the margins. That's more the bear scenario. If they can't do that, it's going to be more the bull scenario. So it's kind of helped me start to think about my bulls and my bears. Okay. Another one, that the sales targets for Nvidia are pretty aggressive, right? And you know, everybody agrees AI is the next big thing, and so that's the point. Like, how big is this pie going to get? And how much of a share of that pie is Nvidia going to actually have longer term? I mean, you go back to again 2000. You know, one of the most valuable companies out there was a company called Cisco. They were the first $1 trillion company. Now they're worth 1/8 of that, right? Because the market kind of overshot, and they were expecting to be too big for networking. Well, is that what's going to happen here? Like, are we overshooting the sales growth? Because remember, in our as is, I mean, a key assumption, we have a perpetuity G of 10.62%. That means when they are a $172 billion firm in 4 or 5 years, they're going to grow that at 10.6% forever. And the law of large number effect comes into play with everybody, including Nvidia. So maybe that is too aggressive, or maybe it's not aggressive enough. Maybe this really is going to be a gigantic company long term. But that's going to be a critical. How fast does this market really grow, and how big does it really grow up to? Another issue highlighted in the BICO is the trade war. Right now, we have very frosty relations between the U.S. and China. And the Biden administration has prohibited exports of Nvidia chips at the high end to China. Well, China's not sitting around. They're not going to say, oh, well, we're just not going to develop these AI chips. And it's not just China. Every country in the world is trying to do this. And so that's the point. Like, are other countries going to create their own versions of the Nvidia chips, which are being sold competitively in the world? And how much does the US and Nvidia participate in that if we're having these trade restrictions? At the other side of the story, how competitive will those chips be? Again, that's a little bit of an unknown, but that might affect how we start to think about the bull and the bear. Okay? And AI is going to be, right now, a lot of it is in data centers. And data centers use a lot of electricity. Okay? The more I read about them, I'm surprised at how much electricity they use. Matter of fact, right now, they're having trouble. Amazon, specifically, I was reading about this, is going to start building data centers for Amazon Web Services in, I think it's Mississippi and Wisconsin. And you're thinking, like, why Mississippi? It doesn't seem like the tech capital in the world. And the answer is because there's not enough power in Virginia to build more data centers. Like, we are capped. And with the data centers that need to be created, like, they're going to start having blackouts and basically taking power away from people's homes because there's not enough electricity to build the data centers. So the data center companies are having to go where the power is. So one of the reasons they were looking at Mississippi is because Mississippi has a surplus of power. And so that's the point. But longer term, the next decade, we have to have double the amount of electric generation capacity in the US that we have today to support, and this is a lot of the data center growth, a lot of the AI growth, and a lot of the electric vehicle growth. Like, we can't actually have all the electric cars sold because there's not enough power to power them all. So that's going to be a potential limiter here. Like, if we don't actually have the power capacity in this country, we can't actually build all the AI capacity we're doing this. And the problem is right now, we're not building a lot of this. We're actually retiring power stations. We're retiring coal-fired plants, we're retiring nuclear plants, and they're not being replaced at the rate that they need to be to double capacity in a decade. So how does that play out in terms of Nvidia's ability to sell chips? Because they don't have customers that are growing, then they can't grow with their customers. So another factor. But here's another one, autos. Don't forget, AI is used now in cars. And increasingly, self-driving cars can be powered by chips. Nvidia is trying to play out that market. How successful is that market, and how big a stake does Nvidia have? That might affect our bull and our bear. Okay? Same thing with gaming. How big can gaming continue to get? And because that's a market they've been in historically. So all of these factors are things we're going to have to start considering when we start modeling out scenarios for bulls and bears for Nvidia. Okay? Dominance, competitive advantage, etc. And that's just a start. So you can use the industry reports that we used for our EIC from, what was the company? Did you go to VBIC? Who was that? We did the EIC. Who did you get the industry reports from? Sorry, I'm just flaking out today. I'm sorry? IBIS World. You can look at an IBIS World report. You can do the BICO. You can read an analyst report. Analysts are talking about the same thing. BICO's the summary of the analyst reports. But the idea is you want to think about what are the drivers that could lead to upside and downside. Okay? And then we're going to start creating our scenarios here based on how those drivers could potentially play out. That's the idea of the bull and the bear. Okay? The bull is the kind of the optimistic assumptions. The bear is the pessimistic assumptions to create a potential range of where the stock could end up in the next 12 months. That's kind of what we're going to do next. Right? So, by the way, as we've been talking about, this is playing out with Tesla right now, right? Matter of fact, tomorrow for the Bloomberg Trading Challenge is a really good day in terms of the stock is going to move at Tesla, just as a highlight, because they are going to report fourth quarter sales. They're not going to report fourth quarter earnings, but they're going to report fourth quarter sales, right? And right now, it's starting to look really ugly for them, right? Matter of fact, the reason it's looking ugly, reading on Bloomberg this morning, is because car registrations in California are down 50% from last year for electric vehicles, which basically means if California is one of their leading markets, they're going to shrink in the fourth quarter. They just didn't sell enough cars, all right? Now, the other problem they have is essentially there's a company that does surveys for car buyers, like who's your first choice for an electric vehicle? Tesla is no longer the first choice for an electric vehicle. Okay? That the companies are starting to surge ahead, BMW, General Motors, even Ford. People are looking at those, they're not looking at Teslas as their number one choice. And that's new, right? Because Tesla historically has been almost the only game in town, and everybody wanted a Tesla. And unfortunately, what the surveys are saying is Musk himself is partially shooting himself in the own foot. Because the crazy crap that he is saying out there is actually impacting his buyers. And he's creating a toxic brand where people don't actually want to pay money for that toxic brand. It's not en masse, but it's starting to show up. So all I'm saying is that we're doing bulls and bears of Tesla, for example, in terms of the modeling. That's going to be something that increasing Wall Street's going to be looking at. And if they don't grow in the next couple of quarters, that's going to change the long-term outlook of the company. Could something like that happen to Nvidia? All right. Now, I'm not saying Nvidia is going to go buy a company and start saying terrible stuff that drives everybody crazy. Like, that's not what I'm saying. But here's the thing. In the next 12 months, when we were talking about this a few weeks ago, I told you that when Nvidia announced earnings, everybody's going to look at the earnings to say, to hit these extreme growth forecasts, they got to kind of hit all these things along the way. And if they miss a quarter where they grow a lot, not a gigantic amount that's expected, that slightly lower growth rate could really hurt the stock price. Just as an example, because they're going to grow not as big as maybe we expect. So we're always looking for clues, all right? But again, the bull and the bear, we should be kind of absorbing these clues, telling our story of the upside and the downside. So here's where we're going to now turn this a little bit more practical. So I'm going to go to my model. Okay, and this is my as is that we did last Wednesday. File, save as, and I'm going to start with the bull. So what could change in a more positive scenario over the next 12 months? How much better could they do? I'll start over here on the ratios, and I'll say, okay, one of the things that could change is this EBITDA margin into perpetuity. Okay, right now in the as-is, we have it at around 66%, which is down a little from 2029 at 71%, but it's still much higher than it is today at 56. So here's the point. Let's say that the scenario is that Nvidia actually does maintain its competitive advantage for a longer period of time, right? That their chips, which are substantially faster and better than everybody else's, stay that way, almost like Intel did, for a longer period of time. Other companies have trouble kind of copying that. People continue to pay that premiums in the data centers especially, and Nvidia continues to lead the way for a longer period of time. So I say that maybe their long-term margin is not 66, it falls to closer to 68. Okay. Well, that now means a 920 share price versus an 899 share price. Okay. Second, what do I think is going to happen to this one-year growth rate? Well, they stopped growing in 2030 already, assuming our as is. Maybe they don't really grow much, but maybe they grow a little bit more. Maybe they grow at like 3% longer term. Okay, it's not huge, but now my share price is up to like 932. Okay. And then tax rate, I don't think the tax rate's going to get much lower, even in a more optimistic scenario. If nothing else, I think it might go higher. Something the tax rate alone. Productivity, I don't think I'm going to change the balance sheet, because I do think that despite the fact that they're getting economies of scale, everything I told you about earlier still involves big investments, and they're going to have to spend a lot of money for this growth to just put the infrastructure in and make the chips. So I don't think they're going to change the balance sheet ratios. But the big one is going to be here, which is what do I do with this G? 10.62%. All right. How much higher can it go in perpetuity? Right. So here's the point. Number one, from a perpetuity standpoint, math plays out. All right. The formula for perpetuity is cash flow divided by R minus G. Your G is bounded by your R. You cannot have a G greater than your R. That's ubiquitous math beyond this class. So given that their WACC is 13%, they can't have a G higher than 13%. By the way, last semester in the group project presentation, this happened with a team. Their team put in all four models a G of around 45, 46%. Okay, they got a terrible grade. They were pissed off at how bad their grade was. And I was like, hey, I'm not going to give you credit for making stupid math decisions, okay, regardless of this class. Just because they use the solver in Excel and the solver gave them an incorrect value, they should have realized that they were making math errors. So I'm just going to remind you, math still applies here, okay? And in perpetuities, your G can't be greater than your R, okay? So I know that even in Nvidia, it can't be greater than 13% a year, and we're already at 10.62, okay? So if I think about upside, I'm not going to go to even, 12 or 13. I might say upside for them is 11, okay? And the idea is that their market for cars and gaming chips, in addition to data centers, also starts growing a little faster. So incrementally, I'm going to say 11% a year. That's a little bit better. Question?
I understand how the math doesn't work out, but do people make predictions that G will be greater than R and there's ways to value it?
Yeah, people that didn't go to business school.
Okay, so that's just...
I'm just saying that financially in a modeling, you can't do that, right? But I'm not saying that you can't come up with a share price that's unrealistic because people make mistakes in the math. Matter of fact, you want to see that one? Today, look at what's the Donald DJT. They came out with an 8K this morning or 11K this morning, which showed that they had $2 million of cash on hand, 40-something million dollar loss, $4 million of revenue, and they're expecting operating losses for the next few years, and they don't have enough cash to run their business. And basically, they're worth $6 trillion, or $6 billion. Like, I don't know how you come up with that valuation, but their share price is already down 25% today, just at the start of the class. Okay, so yes, he's got his sheep out there who believe in the religious cult figure who are buying his stock because he tells them to. Matter of fact, get your Bible, $60. Buy your shoes, gold shoes, which is ironic. He's selling gold shoes and a Bible together. Did I read the Bible and say that that's like bad? Anyways. But nonetheless, I'm just saying that the math doesn't support it, and you're already seeing its stock price fall. So it goes back into anything. Math always should prevail regardless of whatever company you're evaluating long term. I'm not saying the short-term emotions don't take control, but we got to get beyond that. All right, so back to this. That's 11%. That bull works out to a share price of $1,089. Okay, so my opinion on how high the stock can get in the next 12 months is $1,089. Now, what's interesting is there's a couple of people on Wall Street I showed you that think it could get even higher than that. I don't think that's realistic. I think this is actually my bull. Okay, so that's my top end of my range, 1,089, for these reasons that I just explained to you. Okay. Now, save. I usually like to go back to the as is. So open up my as is for Nvidia. File, save as, the bear. Call this the bear for the video. All right, so now I'm putting on more of the pessimistic view. What might not go as well for Nvidia over the next 12 months, and realistically, that could actually cause the share price to go down, right? So first, I'll get back to competition, right? That the competition really does become stronger faster. That the companies out there, the Amazons, the Microsofts, which are actively encouraging competitors, a lot of people trying to create their competitive chips, they start becoming much more viable alternatives faster. So that the margins start to fall. And instead of hitting 66% long term, 56 was still pretty strong, they get closer to the 56. So maybe their margin gets closer to 60. Okay, longer term. So they still have some period of competitive advantage, but it's a little shorter and not nearly as strong. Okay. Assumption number 2, we have an election in this country in November, right? As a scenario, the Democrats win. The Democrats win the House, the Senate, the presidency. What they promised is they will raise the corporate tax rate. It's going to 28%. So the bet is if the Democrats win, a reasonable scenario, corporate taxes are going up. Okay, so instead of 21%, which is where it is today, it goes to 28. And there are big believers in minimum tax, which means less loopholes. So more people have to pay a corporate minimum tax, kind of like the alternative minimum tax for individuals. So that means Nvidia is not going to pay 17%. They're going to pay a higher rate. Right? Now, right now it's 21. They're paying 17. They're a global company. There's other breaks they get. So maybe it won't be 28, but maybe it goes to something like 22. Now my share price is down to 763. Yes.
So does that mean if the Democrats win, like all stocks will pay?
If the Democrats win, be careful what happens with your 401k in the short term. We know by math from your midterm question, key value drivers, that if you pay more in taxes, your values go down. So yes, if the Democrats win, stock prices will take a hit. Yes.
Biden's administration has been promising 28% tax rate since he came in.
Yes, he's been promising it, but with a Republican House, they can't implement it. That's what I'm saying. The assumption here in the bear scenario is that they flip the House, keep the Senate, and win the presidency. Those three things happen, they will be able to change the tax rate. Okay? But if they don't win those three, the tax rate's not going to change. It'll be where it is today. That's why I put that in the bull scenario. Just as an alternative there. All right. As I said, you could differ with me, different opinions, but that's the idea. I'm telling my story for reasons why I'm making the assumptions that I change. The biggest assumption I'm going to change, I'm going to leave the productivity alone, even in the bear scenario. I don't think they're going to spend more, but it's going to be this G. Okay? And I don't disagree that I still think there's going to be explosive growth. I just don't think it's going to be as explosive. And essentially, I'm going to put it at 8%, which is still, for an economy growing at 2 to 3 as a mature company, 8% forever when you're a $170 billion company, that's still pretty strong growth, right? And that's the point. Just like what's going on with Tesla, right? The problem with Tesla is that, as we talked about, the road to electric vehicles is longer, and it's getting harder to get to the mass majority. And we just overestimated how fast things transition. I think the same might be true with AI, that the transition to AI might take a little longer, and the amount of investment that people are making is very expensive. In fact, I was reading a CFO survey. CFOs of the Fortune 500 on your investments in AI next year, 7 to 8%. That's the average. And it's just they want to be conservative. They kind of wait and see before they get the investments. They don't just rush out there and spend a lot of money. Well, maybe that slows down the track a little bit. And as I said, maybe Nvidia also gets a little bit more competition. And so I say still dominant, 8%, not 10%. By the way, that share price, 421. So what I've given you is my range, okay? The top end of the range, I'm closer to 1,100 a share, forgot whatever that number was. The bottom end of my range, I'm closer to 420 a share, might round off, okay? But that's where I think Nvidia can end up. I personally think, with my assumptions, there's more downside than upside to Nvidia, okay? Which is actually one of the reasons why I wanted to do this exercise. So transparently, I own Nvidia personally. And I was trying to figure out, what should I do? I've had a pretty good run up. Is it gonna keep running up? And everything that we're doing in this analysis tells me, I think it's near the top. And it goes back to, sure, could emotion take over and some unreasonable prices happen in the short term? Yes. But the basis for that, you see the math. It gets harder and harder to believe that that's a sustainable long-term price for that company. And people eventually look at cash flow. So I think there's more downside than upside risk. So personally, I'm probably going to be selling my Nvidia stock, right? And looking to invest in something else. Not that it's a great company, but I've had the run, and I think they're already kind of priced close to perfection. Because I don't think there's much more upside. They're not going to double their share price again in the next 12 months. If they do it, they're doing it for completely uneconomic reasons. Yes, sir.
There's a lot of talk about how rate cuts are.
Correct. And right now, I have left the WACC alone. But you could make an argument that the market has not completely priced in the rate cuts. And let's say the yield of the 10-year goes to 3.5 versus 4.5. And so the cost of capital for Nvidia, 13%, maybe falls to 11 or 12. And say call it 12. Well, that would actually effectively give another 50% to the share price. You could put that in your bull scenario as well. All right, I'm not, but you could. Okay? So I'm talking about next 12 months, because that's the other thing. What's going to happen in the next year? That's the target share price, right? So unfortunately, inflation's been stubbornly persistent, and the Fed seems to be staying above the politics, and they've been leaving rates where they are. And if inflation stays a little higher than expected, I don't think long-term rates are going to fall either. That's an assumption I would play out in mine, but something you could articulate differently if you're doing scenarios in yours. Absolutely. Reasonable point. Yes, sir.
How did you select G, the long-term growth rate?
I selected the 8%, more, I would just say, sticking my finger up and feeling how hard the breeze was blowing. But basically, based on some of the things that we were talking about, I just knew it was lower. And so I wanted to have something that approximated the high growth that was a little bit lower. That's the honest answer. Now, I could be doing more research That's why I say go back, look at the analyst reports, see what they're talking about for their bulls, their bears, and data based on this. I'm doing this kind of riffing here in a few minutes, but this is part of what you're going to be doing. You got to have a basis for whatever number you're doing. And my basic is basically saying growth not as strong as expected. But still pretty strong growth. 8, 9. But either whether it's 8 or 9, share price is substantially lower than where it is today. You can see what the scenarios are. All right. So here's the final point. Save that. That's my bear. So I got my bear at one end at 421. I got my bull at the other end at 1,089. Where do I think it's going to be in that range? Now you can put in your opinion. Okay? And here's what's very important, your opinion. Your opinion has to be a price within that range. Right? You can't have a target above the bull or below the bear. I say this because I've had students do this in the past. And again, you get dramatically penalized when you submit that stupidity in this class. Like if your target share price was 1,200, you can't have a bull of 1,100. Your bull should be higher than 1,200, or at least 1,200. Okay? So again, where in the range do you think they're going to end up? That's your target. Okay? Now, my personal opinion. So this is now Joe's opinion. Going back to, and again, I usually like to start with the baseline, the as is. You could do this off of the bull or the bear. Is the following. I think that their margins are going to go down a little bit, but not as much. I'll call it 64. So I think that their margins will be closer to where they are in 2027, above where they are today, longer term. I do think that the tax rates are going to stay moderate, 17%. Not going to change that in the short term. And I do think that the growth is going to slow, maybe not as much. I might put it at 10% instead of 10.62. So just a slight lowering versus the currently pretty high expectations, because I do think that we are at the beginning of the next big thing, and they are growing in the next big thing in the early innings. So they do have some potential growth opportunities there. So I'll put it at 10, and that works out to be, not changing anything else, a share price of 713. Okay, so I'm kind of with the Morgan Stanley people. My opinion is sell. So when you get to your target, you compare your target against your current price. If it's within 10%, it's a hold. If you're more than 10% below the current price, which I am, I would call it a sell. And if you're more than 10% above, you would call it a buy. So my final answer would be Nvidia sell. Okay, that's my realistic expectation. But if you're doing this exact same analysis, you could have slightly different assumptions, and we can't grade you to being incorrect because we're dealing with the future, as long as you had a reasonableness to why you're making those assumptions. So you could have a bull that says Nvidia's bull case goes 1,300. You could have a target of 1,100, and you can have a buy recommendation, which is completely different than mine, and that's okay. Because if you go back to ANR, both of those exist right now on Wall Street. Okay? And I can't tell you who's right or wrong until a year from now. And then we'll look back retrospectively, and then we'll see. But when you're actually doing the exercise, it's going through the process and supporting it with assumptions and data. Yes?
When we do the target, do you want us to make like a fourth file?
Yes. So when you submit your next homework assignment, you're going to submit 8 files. Okay? 4 Excel models. The as is, the bull, the bear, and the target. 3 Bloomberg screenshots. DES, WAC, EEO. And a minimum 500-word paper with the narrative of the assumptions. When I went from the as is to the bull, here's what I changed and why. When I went from the as is to the bear, here's what I changed and why. And the and why is very important. When I came up with my target, here's what I changed and why. That's what you're writing up. Okay? Yes?
I think you mentioned earlier this semester you own Nvidia stock.
I do. I just said right now I own it, and I'm going to actually try and make a decision. And I told you, my personal decision is I'm going to sell it. I'm cashing in. And I'm willing to give up 10, 15% short-term upside, because and this is what I'm showing you here. My personal opinion, for reasons I gave you on this video, are I think there's more downside risk than upside risk to Nvidia right now. I think there's an emotional part, but here's the thing. Come early April, May, whenever they report their next quarterly results, they're going to have to hit those targets. And those targets are pretty high, and you can see that in your as is. And any slight miss, where it basically says that trajectory is a little lower, You see what happens with that slightly lower trajectory to their share price. And that's what I'd be more worried about than the upside. Because to go beyond what's in our as is, you see the math, that just seems really hard to do. Okay? I'm not saying they can't, but I'm just saying I'm more worried that they can than can't because of a lot of things that could be happening for reasons that we talked about. So it's just not worth the upside downside. I took my upside, I got to go find something else. So the team that's kicking ass and made 12% a week, see me after class. I need some recommendations. Yes.
Why do you think so many analysts predict high upside?
It's easy to get caught up in the emotion of the short term. It's a crowd. Because that's the thing. Right now, what I worry about, reading about, is the meme stock people are here. And they're like, oh, to the moon, Nvidia 2000, double again. Well, that means they're going to be a $4 trillion company. How do you get to a $4 trillion valuation? It's like the people with the Donald Trump stock. How do you get a $40 million operating loss in a company that basically says we don't have enough cash to run the business to be worth $4 billion? Like, it just doesn't make any logical sense. Eventually, the logic plays to the real prices. In the short term, speculators. And that's the point. I think right now there's speculation on Nvidia. That's what's pushing it up. That's my personal opinion. But I'm not willing to just own a stock on speculation, because when the speculation goes away and the reality comes in, this is Warren Buffett. Like, you know, beware the broken stock. Broken stock on the downside, broken stock on the upside. I think that there's more downside risk than upside. Why do I want to take that volatility? That's my personal opinion. I could be wrong. I could miss out on a lot. You might come up with something differently. When I read the 182 papers, maybe you'll change my mind. Yes?
Would you consider getting puts on it at the long term?
We are not doing short-term trading in this class.
I mean, you.
I'm just telling you, we are not doing short-term trading in this class. Notice when I said target stock prices, 12-month targets, right? Because a lot can happen day to day, right? I don't know what's going to happen over the month of April. I just know that longer term, that I'm worried about their stock price. That's what we're doing in this class. This class is not about day trading, okay? Day trading, the element of this class that's closest to day trading is your Bloomberg Trading Challenge. Because the whole point of the Bloomberg Trading Challenge is to understand expectation against reality. And when the expectations change, the price changes. Okay, so what is that expectation? And in a way, we're just doing a long-term version of the expectations. My bull and my bear says these expectations might be a little high, right? And so therefore, I think if the expectations get lowered just a little bit, even though they're very high, they go from extremely high to very high, then that's a big change in the stock price. That's what I'm nervous about in today with Nvidia. But I could be wrong. You are going to be writing this up yourself for the next company. But this is what I want to get to. And if you get good at that, you can make a lot of money on Wall Street doing this until AI completely replaces you. But you got about a 5-year run before you get laid off. But these people make like $850 a year, so it's not a bad living. All right, questions, comments about this? All right, so now the next question should be, how do we do this for another company? How do we turn this into the reusable model? So we're going to practice with Nike. Okay? So what I'd recommend is we'll start with our as is, which, by the way, let me save this as my target. These files. Sorry, I just have a lot open from the previous class. All right, here we go. So I'm going to start with the as is. You could technically use any of the 4 files. I usually like to start with the as is. Okay. So the first step is we're going to do Nike. So file, save as, my Nike as is. This is the one that's on the video. All right, what matters is this first tab. So this worksheet in our model called model data is the raw data, 6 years of historical income statement, balance sheet, cash flow data that this model for Nvidia is based upon, okay? What we need to do is replace this with the Nike data. And it's going to come from Bloomberg. Okay? So this is where Bloomberg starts to come into play. So you'll go to Bloomberg, and you'll go to Nike, and then you'll go to FA, which is historical data. And then you'll go to custom. Create a custom will be blank. Your custom will be look like this. Now, I'm going to do this in two parts. I'm going to go back and talk to you about how to create the template after I do what I'm about to do. But you would have created a template. Mine is called model that you've saved, which is the format of 6 years of historical data for, in this case, Nike is being loaded, that exactly matches this worksheet in our Excel file. Okay? So this is this exact same formatted file in Bloomberg with the real-time data, and because it's a template, it has Nike's data in it. That's Nike's revenue, Nike's profits, Nike's balance sheet, etc. Okay? So once you have this file in Bloomberg, you will export this to Excel, the current template, which is, in this case, my model template. And what's going to do is it's going to download this data from Bloomberg and put it in Excel. Okay? But a couple of very important things along the way. It's doing it with the Excel with Bloomberg add-in. You'll notice up here in my Excel file, it says Bloomberg. If you don't have the Bloomberg add-in loaded to Excel, it will not download. It'll error out. Okay? So you have to use the Excel with Bloomberg add-in. At a terminal in one of the labs, you will go to the Start menu and you'll load Excel with Bloomberg. It specifically says that. If you just download regular Excel, it won't export, okay? Because it needs to have the plugin to link to Bloomberg to download this data. So Excel, you gotta load on those computers, pick the one off the Start menu that says Excel with Bloomberg, okay? And you'll know you're in Bloomberg because it'll say Bloomberg across the top, okay? And then here's why this is important. This data on Nike that I just exported are not numbers, right? If I go over here, and I'll make it a little bit bigger so it's easier to see. If I go to 2023, 51,217 of revenue for Nike right here, and I click on that, it's a formula, okay? This is the whole point of the add-in, because it's a lookup. It's a database lookup, because what's happening in real time is this template has these formulas to look up fields in the database, and it says look up Nike's this year revenue, and it just shows me the displayed format number, okay? Now, in order to put this into my model, I can't put in these formulas. So what I'm gonna have to do as the next step is select this file that was just exported, select the whole worksheet in the upper left-hand corner, copy the whole worksheet, paste special values. So what that's going to do is it's going to take all those formulas and replace it with numbers. Now that's 51,217. Okay, that's very important because if you don't do that and you save this file and you leave the lab, when you open it up on your own laptop, it'll error out because it won't be able to access the Bloomberg database and see the files. Right? Now I'll tell you the other side of it is if you had your own personal Bloomberg terminal on your own laptop, it's really cool because you can literally just open up a file in Excel and in real time get a real feed to all the data from Bloomberg. So you can actually work in Excel and never even go to a terminal. A lot of people do that on Wall Street, right? But you don't have that luxury. You're working in the lab. So to leave the lab, you need to leave with numbers. You can't directly access the database. So copy, paste special values on what's exported. Second important step. We're about to put this into our Excel model and work on the formulas. But Excel does not like long dashes. And for whatever reason, Bloomberg will take missing data, and instead of put a missing data, call it a 0, they'll just call it a long dash. They treat it like a 0. But Excel does not like dashes for formulas. So if we have long dashes in our Excel model, it'll error out our Excel model. We can't have long dashes. I've asked Bloomberg for years, is there a way to get you to export data without dashes and put zeros? They said no. So this is our workaround. We then have to take our file with long dashes, copy one, find, paste the long dash, replace with zeros, replace all. For Nike, it's going to take 38 long dashes and replace them with 38 zeros. Okay? That's step number 2. You'll have to do this every time. Then, save your data. File, save as. I'm going to put this in my downloads folder. And I'm going to call this, did this in previous class, but I'll overwrite it, Nike-data. Call it whatever you want, but that's my data file that I've exported from Bloomberg. Okay, so I'll save that. Replace. Okay. Now, on this computer, which I'm recording off of, I have 2 versions of Excel, right? Because this is a Mac, and Bloomberg only runs on Windows. It does not run on the Mac, okay? So I have a piece of software called Parallels, which allows me to run Windows 11 on my Mac, right? This version of Windows 11, which is the PC version, see it across the top, this version of Excel has the Bloomberg add-in. My Mac version does not have the Bloomberg add-in. So what I'm going to do is I'm going to close this file in Windows, and I'm going to go to my Mac version of Excel, which you notice across the top, it doesn't have the Bloomberg add-in. File, open, downloads, this data file. It's not loading. Just click on all of it. All right, so there is the file without the Bloomberg add-in with all the numbers, okay, which is what you're going to probably be doing. Here's our next step. I'm going to take this entire worksheet, select it, and copy it. I'm going to go to what used to be the Nvidia model that I've renamed Nike, select that whole first tab, and then same thing, paste special values. So it's literally overwriting, row by row, all of the numbers that I've just exported from Bloomberg, from that model template, into the model template that's now in my Excel file with the Nike data. So the Nvidia data has been replaced by the Nike data. Okay? So if I were to go look at the income statements, those are now the historical Nike income statements, historical Nike balance sheets, and the check that I will want you to do is go to the CFIs. Those will be the historical Nike CFIs. Make sure that your historical CFI balances. If it doesn't balance, it's a problem. You're going to have to fix it. Okay, but I got balancing historical CFIs. Right? But here's the problem. Like, notice how my notepad goes from 4.8 billion to 58 billion because I still have some Nvidia assumptions in this model for like margin, which are far different than Nike's margins. Okay, so now I'm going to start updating. So I go to assumptions, and the first thing is last reported year. For Nvidia, it was 2024. If I look at the historical data for Nike, it was 2023. So I come back to assumptions. I change 2024 to 2023. Okay. Told you we're not going to screw around with the operating cash. The 13% was Nvidia's WACC. I need a Nike WACC. So I go back to Bloomberg for Nike, WACC, take a screenshot, 9.7%. So here's my screenshot, save, NKE WACC, and then go back to my model. $9.7. Next, shares outstanding. Nvidia had 2.5 billion shares outstanding. Nike's going to have a different share count. So I go to, back to Bloomberg, DES, share count for Nike, 1,217.2, so 1217.2. 1217.2. Current share price, that was Nvidia's share price. Nike, 92.44. Okay. Make sure you take a copy of the TES screenshot, which I didn't do. All right, screenshot number 3, EEO. Let's go ahead and take my screenshot here. This is my Nike EEO. And so that's the point. I need to put in these revenues and EBITDAs for Nike, which are far different than Nvidia's. So for example, 2024 revenue, 51,723. So 51,723. So this, 51,723. For 2025 revenue, 53,000 even, so 53 billion, 53,000. For 2026, 56,167. For 2027, 60,195. $2028, got to go one column over. $63,985. For EBITDA, for Nike, actually I'll start in 2028 because I'm already there. EBITDA in 2028, 11,237. Work backwards, 11,237. For 2027, it's 99,37. For 2026, 88,29. $2025, 7907. And I'll go back, column 2024, EBITDA 7223. The trading multiples based on the DES screenshot or the DES price. EV to revenue, second and third year, 267 and 252. 2.67, 2.52. EV to EBIT, 1978 and 1764. 0.78, 17.64. So their margins, EBIT margins in perpetuity, 13.5 to 14.3. Okay, based on the trading multiples right now. Which means this number, which 65% in perpetuity is the Nvidia carryover, which is giving me this crazy negative share price. I need a more reasonable number. 14.3 at the high end. To get to 14.3, I got to make my EBIT 15.7. That's the high end of the EBITDA range. By the way, the other one I kind of skipped over was the G. Right now, my G's 10.62 was higher than my WACC. That's mathematically invalid. That's why I'm getting this really weird share price. Right? As a placeholder, I'm just going to put in 3%. We're going to solve for the G in a minute. Just put in a reset at 2 or 3%. All right? Now I'm back to $75 a share. I'm much closer to the 92 I need to be at. Tax rate. This is Nvidia's tax rate. I need Nike's tax rate. So I go back to Nike, GUID, see if they give tax rate guidance. And the answer is they do not. So the company is not giving tax rate guidance to Wall Street. That doesn't mean that Wall Street isn't trying to figure out what Nike's tax rate is. They have to do that, right? So now we're going to go to alternative. If the company doesn't give us guidance, what we're going to do is we're going to use JP Morgan, okay? Because every Wall Street firm has to do exactly what we're doing. They're trying to figure out the guidance, if they don't get it, what the tax rate they think is going to be. And we have access under BRC to certain analyst reports. And one of the reports that comes with our subscription is JP Morgan. We get JP Morgan, Wells Fargo, Deutsche Bank, some Barclays every now and then, and Mizuho, and a company called Woozy. I'd stay away from a company called Woozy. Sorry. If you're interviewing with them, I wouldn't give them a lot of credit on Wall Street. But in any event, the thing about JP Morgan, there's their more recent report, is I know that JP Morgan always includes a little bit of their financial model in their analyst reports, and tax rate's always in there. Okay, so it's just, I know it's going to be there. So you open up the JP Morgan report. Here's one from March 27th. This is the PDF of their buy, sell, hold recommendation, which they're currently a buy on Nike. Search the PDF for tax rate. And right here is their forecast for the out year tax rate, which right now they're using, what's that number? Make it bigger. 16.8. Here's what that number says. It's kind of hard to read. I think it's 16.8. Yeah, 16.8. Blowing it up. So go back to my model here. .8%. Okay. So I got a 75, 78 share price right now. Back to productivity. IC to sales historically 30%, future 30%, not changing. I'm assuming Nike's productivity is not going to change. I'm going to leave the balance sheet alone. So I got a tax rate, got a margin, revenue growth in the out year, 6% for that 1 year alone. Okay, they've been growing mid-single digits. I'll give them credit for 6% in the out year. I don't think that's going to make much of a difference. So my final one is, what's a reasonable G? So now here's where I'm going to use my goal seek. So tools, goal seek. And I'm going to set the share price, which is D30, off the valuation tab, to 92.44 by changing the G. And that's going to give me a G of about 4.74%. And at that G, I get a 92.44 share price. That is my Nike as is. Right? And that probably took 20 minutes because I'm giving you explanations along the way. You can probably do it in 10. And by the time you get to your third model, you're probably doing 7 or 8. And that's the whole idea. This is what you're reusing to do another company. That's the process you got to follow. This has been recorded, by the way. But this is what you're going to have to do for next week. This is the first file. We're going to practice this on Wednesday for Nike, just to get here and do the bull bear target for Nike before you do the next company for your homework assignment. Questions about what I just did conceptually? Make sense? Okay, that's building the reusable model for the as is. So here's the final thing I want to cover today, which is how did we get to this file that got exported of the Nike data? Okay, so this is what you're going to have to do in your Bloomberg terminal. Magnifying glass. Suspend that. Whoa. Go back to 100%. There we go. All right, so for, in this case, Nike, we go to FA, and we go to custom. Create custom. Should be blank. Okay? Now, you'll notice here I have 6 years of historical data. All right? By default, your terminal exports 10. And if you export 10 years of data, it's going to choke the model. So you need to have 6. So alternative 1, which I don't recommend, is up here where it says periods. You change that from 10 to 6, but you'll have to do that every time. Or better, alternative number 2, go to your settings, where it says number of periods, change that to 6. That way, every time you export data, it will only export 6 years. You don't have to think about it. So 10 to 6. Your default is 10. The second thing you need to change is the second tab under settings called data. These 4 things, make sure they're unchecked. If they are not unchecked, it will export extra columns. Every one of those 4 things is an extra column in your data export. The model will not like any extra columns. You only want 6 years of historical data. So uncheck those 4 boxes. Yes, question? All right. So uncheck those 4 boxes, make sure it says 6, and then hit update. Then you'll see 6 blank fields. Okay? And again, it auto adjusts for company based on the years. These are the 6 most recent years. For Nvidia, it went through 2024. For Nike, it went through 2023. Okay? And then here's the final piece. This worksheet is the link to Bloomberg. There's 2 columns that matter, column A and column B. Column B is the critical one. Those fields, for example, sales underscore rev underscore turn, is the database field name for the friendly name revenue. Okay? And what's very important is column B, database fields, never change. If Bloomberg were to ever change this database field, it would create an earthquake in the financial community. Because for 40 years, every financial firm is pointing to the Bloomberg database and expecting that sales rev turn will always give them revenue. So that's the critical field. However, the friendly name could change. So if we do Nike or Nvidia, it's called revenue. But you go over to the UK and you do AstraZeneca, they call it turnover. Okay? Revenue is turnover in the UK. Still revenue, it's just they have a different word for it. So in Bloomberg, you go look them up, it'll say turnover. You go look up Nvidia, it'll say revenue. But both fields are coming from sales underscore rev underscore turn. That's the critical one. Everybody with me so far? So here's what happens. What I have done is I've created about 80 of these raw database fields that we have to export in this exact order. So this is the template you're going to build. You're going to start with this cell, sales rev turn. Here's the easiest way to do it. You're going to copy it. Copy B6. You're going to go to Bloomberg. In your custom FA model, right here where it says enter field, you're going to paste that. The first one down, you're going to select. Hover over it. In that pop-up box, Excel field ID, sales underscore rev underscore turn. There's the 6 historical revenues for Nike. Okay. Next, cost of revenue. Some people call it cost of goods sold. The field will always be IS COGS, 2 fee, and PP and G. Go figure that one out. Okay. So copy that weird one in B7. Go back to your Bloomberg, enter field, paste, select cost of revenue, hover check, repeat that process 68 more times. Okay? There's no way around this. Everybody's got to do this one time. Okay? So you're going to repeat this. It'll take you about 10 minutes. And you're just going to put those exact fields in that exact order. If you don't have them in that exact order, you'll blow up your model when you export the data. If you export more than 6 years, you'll blow up your model when you export the data. If you get to this point, when you create that template, you will then save the template. I called mine model. Call it whatever you want. That save template will pop up on this menu so that you will then load in the future for any company that save template, and there's my Nike data. When you get to that point, export Excel that current template, which is your model template. That's how you basically get the data out of Bloomberg into our Excel file. All right, I don't have an easy way around that. So that's just, but once you build the template, as I said, you saw Nike template done, export done. That's about 45 seconds. And then basically get rid of the turn to numbers, get rid of the dashes. That'll take you another 60 seconds. And then basically start copying, pasting it in. So within about 10 minutes, you can finish up an as-is for somebody else. Questions, comments, concerns, crippling fears about any of that? Yes, sir.
Do we use this all for Nike?
Yes, I would recommend it. Because here's the point. If you don't do it for Nike, you're going to have to do it for your assignment next Wednesday. So on Wednesday, we're going to start with the Nike as is. I'm not giving it to you, so you can sit here and watch me do this in class. It'd be nicer if you kind of did it with me. Make sure it worked. So create your as is between now and Tuesday, kind of following the process, or at least have your template, right? And then here's the next point. Then you're ready to go for your next homework assignment. If you don't, then sometime after Wednesday, you'll have to do that. So I just recommend getting a start. But you'll need that template, because without that Excel template, you can't do any of these upcoming assignments. And without this model, you can't do the upcoming assignments. That's why I said everything you're doing here is kind of helping you build the reusable model. Other questions? Yes?
Is it okay if like some of like, I guess, friendly names of accounts are slightly different?
Exactly. That's why I said hover over it, make sure it's still the right one. And this is actually one of the things that will probably come up, right? I don't know why, but every now and then you'll put the database column B in there and it won't find it. Okay? This will happen twice in the template based on historical times I've done this. If that happens to you and it can't find the database field, it's there. Like it has to be there. Okay? We're exporting it. I know it's there. Put the friendly name in and it will find the database field. Okay? It's kind of bizarre, but every now and then it's just their software has bugs in it. Okay? So if you can't find the database field, put the friendly name. But when you put the friendly name, there's a lot of friendly names that look very similar. So when you select it, hover over it and it will give you the Excel field ID. Make sure it's that database name, because our model specifically is looking for those database fields. Okay, great question. Other questions? All right, that is where we're ending today. So a few minutes early. Make sure you sign the attendance sheet. Matter of fact, use the time now if you want to build out that template. Take 10 minutes. Otherwise, we're going to pick up here on Wednesday. All right, and again, continue with your Bloomberg Trading Challenge.